We've got another conversation lined up for you, and this relates to mutual funds. And I realize that this is a little bit of whiplash that you might experience, but trust me, this is going to be an interesting conversation. We've got Abhishek Mehta of Invetsa Capital joining us right now. Abhishek, thanks so much for taking the time. I want to talk to you. My pleasure. I want to talk to you about mutual funds that have a certain amount of track record, and we've identified 25 years as that threshold, because we're talking about schemes that were started at the start of this century, and we were wondering how they performed against their peers, against the benchmark, and we've decided to talk about the top 5. First of all, let's list them out, Abhishek. What are the top 5 schemes that have completed 25 years?
So almost about 48 schemes have completed more than 25 years. Let's go a bit into the history. Mutual funds in India was launched almost in 1963, and in about 1993, privatization happened in the mutual fund industry. The 5 schemes with respect to the AUM, which have a good amount of AUM, is HDFC Flexi Cap Fund, SBI Contra Fund, HDFC Large Cap Fund, Nippon India Growth Fund, and Quant Small Cap Funds. These funds have completed more than 25 years and are managing more than 25,000 crores. For example, HDFC Flexi Cap today is managing more than 75,000 crores. It's one of the first large cap flexi cap funds which HDFC launched on 1st Jan 1995. And the returns have been staggered, awesome across the last 25 years.
Yeah, it's one of those schemes that is a household name because of the kind of age that it has. In fact, it is the oldest in this list as well. 31 years is older than the second largest, which is the SBI Contra Fund, and it's also got a significantly larger assets under management as well. The compounded annual growth of this scheme over the course of 25 years is a whopping 19.65%. Wow. And so 10 lakh that was invested at that point would net you 8.9 crore, and even if you think about 10 lakh being a very large amount and here you've talked about 25 years, or is it 31 years all through?
25 years.
25 years, wow. So 25 years, close to 9 crore. But if you did a 10,000 rupee SIP and you did that throughout, this number is also pretty large. 6 crore is what you would accumulate, which is pretty incredible. Let's talk about what has worked for this scheme though.
Yes. So I think Prashant Jain, the legendary, was managing this scheme, and there has been some changes in the fund management also during this journey. But this shows that, large AMC and institutional level AMC, even if the fund manager changes, a lot of times I hear that when a fund manager changes, we should look at the fund, we should consider changing it. But as a AMC on an institutional level, it's not just one fund manager which manages the entire fund. It's policies, it's process, the CIO, the chief economist, so many people manage and take calls with respect to the entry and exit of the fund, that you can see what kind of returns it's had generated over the period of last 25 years.
Yeah. Let's talk about the second one, which is also a pretty old and well-known scheme, SBI Contra Fund. The whole idea of a Contra Fund is that it goes against what the most favored strategy is in that given period. It's an actively managed fund. So explain it, Abhishek. How does this work, and what has worked for them?
So I think, again, the active management, a lot of people talk about, benchmarking it or investing into the benchmark, but always active has been in the last 25 years managed to give a very good return as compared to their benchmark returns. The strategy is pretty simple. They go against the market. Whenever the market is going one side, they try to take a contra call on the sectors and on the market, and which has really worked. It's completely opposite to what the flexi cap does, but the returns have been very good in terms of last 25 years. I would also like to, point one point here, that if you look at the SIP, 10,000 rupees SIP, which is done over the period of 25 years, the person has accumulated almost about 3.6 crore. He has invested 30 lakhs and he has accumulated 3.6 crore. One point shows here is that you have to start early. Somebody who starts late, and even if he's putting more money, he will end up being less with somebody who starts early. So that's why starting early is very important in the journey, and don't miss the first few years in your life.
Yeah, it's a very important point. But I do want to stress, Abhishek, at this point, and viewers, bear this in mind. While we're talking about 19.6% return over a 25-year period for the HDFC Flexi Cap Fund, or even a 14+% increase, or rather, sorry, a 21.9% compounded growth for the Nippon India Growth Fund, which is the mid-cap fund, we're not suggesting that this is going to be extrapolated over the next 25 years, because there are a lot of factors that would affect the performance. This is simply to give you a sense of what wealth generation could have taken place for those people that invested early and stayed the course of time. HDFC Large Cap Fund, you know what I like is that all 5 of these schemes, Abhishek, are from different categories. So let's talk about HDFC Large Cap Fund.
Right. So HDFC Large Cap Fund, like before the SEBI classification, they were predominantly investing into large and mid cap sector. But now with SEBI classification coming into play, 80% of their funds, they are investing into the large cap category. One thing I would like to point out here is, if you see the difference in returns is probably 2 or 3% as compared to, if you compare SBI Contra Fund and HDFC Flexi Cap Fund, the difference is 3%. But if you'll see the end value, you would end up at 4.4 crore or 8.9 crore. There's a difference of 2 times of the end value, a 3% difference in return, and you are ending up double of what you would end. This gives the importance of compounding. Usually in the first 5 or 10 years, this 3% difference doesn't seem to be big. But after 15, 20 years, the 3% difference really makes a lot of difference, and you might end up double of what you would be getting at the end.
Important point that you're raising, and also the work that you put in for the first crore is perhaps the most arduous, the most difficult, and then after that the fruits of your labor come through. Let's quickly talk about the last 2. Nippon India Growth Fund is by far and away the top performer, close to 22% returned on a yearly basis over the course of 25 years, and therefore the biggest value generation or wealth generation. What has worked? What is the history of this scheme?
So I think Reliance used to manage this. Reliance Capital used to manage, and then it got purchased by Nippon. Sunil Singhania was the CIO and very veteran name in the industry, and he is one of the masters in picking up, mid and small cap funds, and that's what has worked. And his philosophy is still being taken ahead, and they are doing wonderful during this term itself.
Yeah, and the last one is a relative underperformer. I guess that also has to do with the performance of small caps over a large part of this period. Because if I look at post 2019 or post 2018 onwards, the way that small caps have gone up is a far cry from what it would have been in the first part of this century.
Right. So Quant Small Cap Fund actually teaches us 2 lessons. The first lesson is that you cannot leave your mutual fund just like people say that forget it. It's not that you have to forget it. You have to at least review your mutual funds once in a year, or at least probably once in 3 years. You cannot just leave the fund and don't do any periodic review. That will be pretty wrong. What didn't work out for Quant Small Cap Fund was in 2000, the market was pretty high. In 2001, when the Ketan Parekh scam happened, the fund went down by 75%. And it had a huge volatility. But luckily, what has happened is, because of the SEBI classification, the volatility in the small cap funds have gone down drastically. If you see 3 years back, the small cap category, the 250th one to the 500 company, was in the market cap of range of 9,000 crore to 3,000 crore. This has drastically increased. Now the 250th one company, the 251 company, which is Apollo Tires, has a market cap of 34,000 crores. And the last company has a market cap of 9,000 crores. So there is a 4 times increase in the market cap of these companies, which eventually gives you lesser volatility and better liquidity when you are investing into small caps. So even though they have a name tag of, a small cap fund, but I I feel that now the volatility and the liquidity is pretty much better as compared to what it was in the year 2000.
Yeah, it's a fair point that you're making. And we've covered quite a bit of ground. What we're saying essentially is that these schemes have performed well, and ultimately even the worst performer has netted you quite a bit of money over a period of time. It's given you close to 12% or thereabouts, and that has caused your money to grow quite substantially. So more often, the time that you spend with your investments is more important than the selection of scheme that you've done, though some can do better than others, which is why it is important for you to have a diversified investment as well. Abhishek, thanks so much for joining me today. Pleasure having you on the program.
Thank you so much.
All right, that brings us to the end of this edition of Your Money Matters. If you've got specific conversations that you'd like to listen to and topics that you'd like us to cover, then let us know in the comment section, and do stay tuned. Lots